The longer it goes on, the greater the systemic risk to the wider peace in the Middle East region, and the greater the uncertainty. And uncertainty is bad for equities markets. So to the extent that the conflict goes on, I think that you'll see global equity markets affected. If the Iranians took the next strategic step, which would be to shut down the Straits of Hormuz, you'd see another digit on the oil price. You'd see the oil price in the hundreds. I'm not sure they're going to do that. But if they did, 60% of the world's supply of export crude flows through a 32-mile channel between Iran and the United Arab Emirates. I suspect that the U.S. and European response to that would be harsh, but the Iranians may feel they have no choice. I don't know. I think that would have a real economic impact. Higher oil prices take cash out of the economy and they increase uncertainty. That would not look pretty. I don't believe it would be particularly long-lasting unless the Iranians have more military capability than we've been led to believe. And I also believe that the economic damage that would be done by $120, $130 oil would ironically mute demand for oil. Not at the beginning. In the beginning, there'd be hoarding. People would be scrambling to get hold of it at any price. But my suspicion is that an already slow global economy would slow down fairly substantially and probably mute the impact of higher prices. But at any rate, for a whole bunch of reasons, including potentially a whole bunch of dead folks in the Middle East, I hope we work this thing out. I mean, one thing that has come out of a series of Middle East problems and has come out of a series of trends around emerging economic nationalism is that various groups in the world have moved to secure more politically secure supplies of raw materials. This is a broad theme. What the Chinese are doing today, investing abroad, tying foreign aid to trade, doing all that kind of stuff, is exactly what the United States did in the 60s and 70s. It's exactly what Japan did in the 80s. The Chinese are trying to make sure that they have access to the raw materials they need for growth. At the same time, the Chinese have succumbed to the political temptation, again, probably learned from the United States, to weaponize those materials that they have an advantage of, in particular rare earths. The consequence of that is that other trading blocs, which need rare earths for technology fabrication, the Koreans, the Japanese, the Taiwanese, the Americans, the Canadians, the Europeans, are scrambling to secure supplies of strategic materials, much the way the Chinese are scrambling to secure strategic supplies. This has interesting implications for investors. On the one hand, I suspect it lowers the cost of capital for producers in areas that are considered to be politically secure to the West, or in areas that the Chinese suggest will come under their sphere of influence. I say this because interest rate for non-investment grade project finance in the mining business is averaging around 15%. And we hear rumblings out of the U.S. State Department and also out of the Industrial and Commercial Bank of China that they have 5 or 6% money available for project finance around politically secure sources of supply for their respective trading blocks. So these are interesting implications of geopolitics. I am not one who believes that geopolitical tensions are an important long-term driver of the gold price. That's an unpopular view in gold circles. My belief is that the principal determinant of the gold price is investors' and savers' faith or lack of faith in the maintenance of their purchasing power in fiat-denominated savings instruments. And people are afraid. Let's look at this bull market. First of all, when people ask me when it started, my temptation is to say the year 2000, because the stuff was at $250 an ounce. It moved eightfold before people understood it moved, because it did so at 8-9% compounded, which didn't excite anybody. The performance of the asset class for 25 years has been excellent. It's done what it was supposed to do. But let's fast forward and get through that. My thesis, which is that gold does well when people are concerned about the maintenance of their purchasing power in fiat instruments, goes like this. The world's reserve currency is the US dollar, whether people want to admit it or not. And the primary savings and investment asset in the world, the one that every other yield asset is priced off of, is the US 10-year Treasury. That's simply a fact. People can deny it if they want, but it's the reference for, JP Morgan Chase. It's the reference for Goldman Sachs. It's the reference. So let's look at the arithmetic of the US dollar and the US Treasury. Top line number. The US government owes almost $37 trillion to bondholders now. And that number gets bigger by $2 trillion a year. Doge, if you look at the most recent Trump budget, was a total failure. But that isn't the bad news. The bad news is that the net present value of unfunded entitlement liabilities in the United States, money allegedly due to people that paid in, exceeds $100 trillion. Net federal obligations, that is, ex the Fed's own balance sheet, exceed $130 trillion. And here's where it gets interesting. The Internal Revenue Service estimates that the private net worth of Americans, non-governmental wealth, is $141 trillion. The source of their money is us. So if you take what we're worth, 141, and you subtract what we owe, 130, there's 11 trillion left over. But it gets worse. The on-balance sheet number grows up by $2 trillion a year, and the unfunded net present value of liabilities increases by $2 to $3 trillion a year, which is to say the private net worth of all Americans is exhausted by debt in 3 years. That's profoundly bad math. How do you get around it? Well, you could say to some old codger like Rick Rule, yeah, we realize you paid into Social Security for 60 years, but that doesn't matter. There's no money. Too bad, so sad. Hope you don't vote. Strong letter to follow. Probably not politically feasible because old folks vote. So what I think happens is what happened in the decade of the 1970s, the last time we had this imbroglio. I think that the purchasing power of the US dollar declines by 75% in the next 10 years. In other words, we honor the nominal obligation of our debts, but we inflate away the real value of our debts. That's scary enough for dollar savers. What's scarier yet is I think we're in a period right now of negative real interest rates. And let me explain. Most people's perception of the deterioration in the value of the US dollar is referenced around the Consumer Price Index, the CPI. And if you believe in the CPI, you believe that US inflation is only 2.5%. But use common sense. Take your own household expenditures in 2020 and today, and tell me that your cost of living has increased by 2.5% compounded. Oh, by the way, the CPI doesn't include tax, so it's only really valid if you're not a taxpayer, which I assume most of your listeners are. But think about health insurance. The government will tell you that health insurance has declined by 18% in the last 5 years. Gasoline prices have doubled. Grocery prices are up 60%. Car prices are up. Rents are up. Mortgages have doubled. My belief is that the deterioration in the US dollar is not 2.6% or 2.5%, but more like 7.5% or 8%, based on the basket of goods and services I buy. And here's where the math gets ugly. If you're getting paid 4.6% on the US 10-year Treasury in a currency that's declining by 7.5 or 8%, you aren't making 4.6, you're losing 3. The US 10-year Treasury, in an arithmetic sense, costs you 3% of your wealth every year for 10 years compounded. What could make you more concerned about the maintenance of your purchasing power in US dollar-denominated savings instruments than an absolute guarantee that over 10 years, your purchasing power, compound, will decline by 40%? And that, I think, is why the gold price is going up. I think the Fed should exist as long as federal deposit insurance exists as a method to oversee the banks. I don't think that the Fed should interfere in interest rates. I think the market should control interest rates. I believe that the institutional bias of the Fed is that they are the only arm of the U.S. government that has any interest in maintaining the purchasing power of the U.S. dollar. I think the institutional bias at the Fed would be to keep interest rates at their current level or raise them in the absence of any political accord in Congress to control on-balance sheet or off-balance sheet spending. I talk on a continuing basis to several low-level Fed employees, and they're horrified by what's happening at the executive and legislative branches, and they believe themselves to be the only institution of U.S. government that stands between the U.S. dollar and an abyss, and I tend to agree with them. I think that there will be almost overwhelming political pressure to reduce interest rates. If I'm wrong, I remember the decade of the 70s very, very well. To give your listeners some sense of context, the early part of the decade of the 70s experienced inflation, but people weren't really concerned about it till 72. By 72, the compound effects of inflation began to be noticeable to folks. And not surprisingly, the gold price in the first 4.5 years of the decade of the 70s went from a price-controlled $35 an ounce to $200 an ounce. Six-fold move. Early in 1975, the Fed, responding to concerns of inflation, raised the interest rate, strengthened the dollar, obliterated gold. The gold price went from $200 to $100, but they also obliterated the bond market, they obliterated the housing market, and they obliterated the equity markets. Towards the end of 1975, they lost their nerve and cut interest rates. When they did that, it was clear to Wall Street that the game was on, that they cared more about the bond market than they cared about the strength of the dollar. And the gold price ran from $100 to $850. I tell you all this because my suspicion is that over the next 10 years, we will see the same deterioration in the purchasing power of the US dollar that we saw in the decade of the 1970s, which is to say a 75% decline in the absolute purchasing power of the US dollar. And it's not going to happen in stair steps to heaven. There's going to be peaks, valleys, perturbations, all this kind of stuff. But if that happens without compensation to savers, without a real interest rate rise, I think that you're going to see a very dramatic market response in gold. The chief risk in a market is always conveniently located to the left of your right ear and to the right of your left ear. And so preparing yourself to do the best you can under any circumstances is absolutely positively the right thing to do. Don't chase fads. Try to invest in things that you understand. Try to invest in things that are out of favor. Try to use common sense. The Fidelity Mutual Fund Group did a study some years ago where they looked at every different investor group they had in the Fidelity universe. Old folks, young folks, black folks, white folks, women, professionals, rich people, not so rich people. And they discovered that the best performing subgroup in their investor universe was dead people. People who did trade, people who didn't chase the latest fads, people who didn't pay too much capital gains tax. Now there's a lesson there. I think people overinvest, they overtrade. I don't think they overthink, but I think that people exercise too much emotion when they invest. And so I would say that the thing that people need to pay attention to is just exactly that. Don't be hyperactive. Don't chase the latest fad. Understand, too, that there's not much certainty in life, but there are probabilities. And if you assess the probabilities and invest with that in mind and understand that to be successful, most investments require compounding, which takes time, you'll do well. Of course, everybody wants the 30-day triple. The problem is that there aren't very many of those. You have to be pretty careful to segregate what you want from what you might be able to have and pay much more attention to what you might be able to have. There's plenty of money to be made if you don't make mistakes.